Okay, thank you, Raleigh. And thank you all for attending and sticking around. I caught the last 20 minutes or so of the previous presentation, and definitely high energy. I don't think I can match that, but I will certainly be trying to answer all the questions and give a clear, concise presentation. What she talked about in gaps I thought was interesting because I focus on gaps quite a bit as well, and I think they're extremely important in the grain markets anymore because you have the night session trading. You don't see gaps very often, but we'll show some of on the charts. We'll talk about gaps and how important they are and how they can be indicators of direction, much like the previous presenter was talking about. But we're talking about weather markets. I think if you're a grain trader, you kind of live for weather markets. Some hate them, some love them. I think they offer just immense opportunity if you can get, if you're ahead of the curve. And you know that whether you're trading futures or options in particular offer a huge amount of leverage. But just recognizing what kind of market you're in and recognizing the signals when the charts are telling you something can get you ahead of the game. It can get you in the market ahead of a big move. Now, when we're talking about weather, we haven't, 2012 was the last weather market that we had. And before that, it was a good 24 years since we'd had the previous weather market, 1988. And if you're a producer or a trader back in those days, that was a very exciting time. And it's interesting how you really hadn't had any serious weather problems in grain production for all that time. And you look at the period before that, you'll see in some of these charts we started in 1973, there were 6 weather markets in a 9-year time frame. So it's fascinating how many there were back then, and then there was this big gap. And or a time period where you had no weather markets. And I thought that was very interesting because I started my brokerage firm in 1988 in November, right after that drought of 88 in that weather market. And I kept looking for them. I studied that market. I knew it inside and out. And I kept looking for more weather markets to come, expecting, you know, this year might be it, this year might be it. And it never evolved. You would get some starts to it, and then the rains would come, or it just fizzled out. And so we had a very long stretch where we had nothing. And then all of a sudden 2012 shows up, and you have a drought and you have a weather market. What I want to talk about is anticipating, you know, having a good service that can help you with the weather. There are tons of weather services out there. The one I use, they were called the Browning newsletter. Now they're called the Browning Climate Report. But what they do is they give their climatology service, and they give long-term weather outlooks. Now everybody's trying to get that. Everybody's trying to get the edge, but they were uh, way ahead of the curve in 2012. But backing up a little bit, on this slide we're talking about the Browning newsletter. Granted, it is hard to read, but the point there is talking about the changing weather patterns. Now, I'm not trying to make a political statement about climate change. I don't know, and that's not up to me to decide if it is or it isn't. What I do know is that weather patterns are changing, and they are affecting farming, not only here in the United States, but around the rest of the world as well. With the help of a service like this, doesn't have to be this, could be any, as long as you're comfortable with it and trust it, but it gives you a leg up in anticipating what your 2 and 3 month outlook could be, what the next couple of years could be. What this particular service is talking about, they're they're watching the ocean temperatures basically. They're doing much more than that, but I'm zoning in on what's going on here in the United States in particular. The Atlantic Ocean has turned warm over the last several years. It's in a long-term cycle. Now the Pacific has turned cool, the Eastern Pacific against the U.S. West Coast. That is just now flipping over in a very long, like a 50-year cycle, according to Evelyn Browning. So Evelyn Browning Garris, excuse me. So now she's talking about The change here is that it's going to be you're at risk for more droughts, basically. And she talks about the impact affecting west of the Mississippi in particular, and the state of Kansas, if you're really going to narrow it down, will bear the brunt of it. But she's got these maps here talking about the warm Atlantic and the cool Pacific, and then of course you have the La Ninas and the El Ninos, and we are in a very strong El Nino now. Those bring warm waters into this cool system, so it disrupts that pattern for a brief time. But when this fades away and the La Nina replaces it, now you've got the cool La Nina coming into the cool Pacific waters, enhancing that instead of subduing it. So being aware of these weather patterns, and of course, it's a monthly newsletter. There's a premier service where you can get the conference calls, and if you have questions, you can talk to her. But again, it's just being aware of the changes in the weather patterns that are going on, and that the general expectation over the next 10 years or so, as we'll see on this on these next slides, excuse me, this is about the 2012, but she's talking about the next 10 years about how the weather patterns will be much more disruptive and much more at risk of drought here in North America. Getting back to 2012 on this slide, I find it with some amusement that many, especially in 2012 and 2013, when they talked about the drought, almost invariably they talked about how it was a surprise to everybody, and they called it the flash drought, and nobody saw it coming. Well, I truly beg to differ, because I can show you right here that on this newsletter, which was the May newsletter, she was talking about hot and dry conditions during midsummer, at least 2 months ahead of when it actually happened, and it did happen. So there are people out there who are calling this, who are seeing this, or who did see it, and it's not just a matter of everybody caught off guard. In this next slide, getting back to the 10-year outlook, she's putting out maps of what she expects to see, the patterns, the weather patterns over the next 10 years. Now I've got North America up here on this slide, and she breaks down, these are all the different crops that are grown, and what she expects to see in each region, whether the Northwest would be more wet, you've got a huge area in the middle of the country expected to be more dry. This is on the left side, and then of course the Atlantic coast being more wet and warm. When you have the warm Pacific, which is like an El Nino, then you would have these other conditions going on. But at least she gives you a sign, something to look for, the general typical weather patterns if you just have that going on. Excuse me. So the next slide here I want to show you is what she's projecting for South America. Now she's looking for, generally speaking, Brazil and Argentina to have pretty good weather, and you can see in these maps that would pan out to be that way, although northern and northwest Brazil would have some dry conditions, and that's actually been the case so far this spring. Central and northern Brazil have had very dry conditions. There are rains forecast, but they've kind of been disappointing so far, and it has delayed the soybean planting. Next slide we're talking about is Asia, what you expect to see there. This gets more difficult to trade, number one, because you don't have a lot of exports coming out of this region. They can be major importers, especially China, obviously. But China, in particular, like their wheat crop, which is very important to them, they irrigate that crop. So much of the dryness and the drought would be negated by the irrigation. And we've seen some very dry years over the last decade, and yet they continue to be big producers of wheat. So they're not big producers of soybeans, but they're huge importers. So what happens in Brazil and the United States regarding soybeans would certainly have a big impact on what's happening in China. Here we have Australia, excuse me. They are looking at generally wetter conditions. So this is primarily a wheat growing area, and that would be better conditions for wheat. And then of course you've got Europe. extremely important area, not only for wheat, but also for corn in particular. Not so much soybeans, although there are some raised there. Much of their meal would come from uh, sorghum. Well, they would have sorghum, but also rye or canola that they would get a lot of their protein from. But here, when you look at Eastern Europe into the Black Sea region, which is on the far right there where the big circular part of the tan, the brown and tan area, that's the major exporting region of the Black Sea, Ukraine and Russia. So they have become the world's price setter in the world market for wheat. And it all comes from that region, which is right next to the ports. The further inland you go, the more expensive it is to get it to the ports. They just don't export the wheat from the northern and the in the Siberian areas of Russia. So, excuse me, when you're talking about wheat production and weather markets and changing weather patterns, this would have a huge impact on world wheat prices if these kinds of weather patterns evolved in the way that it's being projected over the next several years. Now, zoning in on weather markets themselves, there are a number of things. When you look at several charts of weather markets, I picked soybeans because they tend to be the biggest movers and offer a huge amount of, probably the biggest opportunity in a weather market. But you can look at a lot of weather markets, whether it's corn. Corn will follow pretty much the same pattern as soybeans. They just don't move as much. And wheat would have similar patterns as well. But beans are what everybody looks at when you're talking about a weather market and production problems in the United States or even in Brazil. Beans are what you zero in on. So there are several things here that they tend to have in common. One, that the lows preceding the rally are usually pretty quiet. There's no big dramatic washout type of trade to the downside, no spike bottoms. They usually are just kind of a slow bottom, quite often are in a trading range. So you don't really have, you know, again, a washout type of trade to the downside. But once you get started with the weather market, it usually starts with a breakout and with a gap. And here again, we're talking about gaps like the previous speaker. They are very important. And you don't get them very often in the grain markets anymore because of the night session. But when you do, they are very important. And markets will gravitate toward them. So with this next bullet point, the gaps and the breakouts are usually retested. We'll show you in the charts that very often you get that initial gap, the market then hovers right at that gap area, testing and testing and testing before it really takes off. And then as you get into the final phase of a weather market, and really this is the final phase, it's a typical type of price action, whether it's a weather market or just the ending of a big bull move or a bear move. It happens with acceleration. And that's when you get price action where the trading range for the day starts to extend, whether it's because of expanded, whether you've traded limit up and you get expanded limits. You're just trading at bigger volumes and trading ranges than you've been in the previous several sessions. And you'll see that on these charts. And with these accelerations, they're usually the end of the move, and they usually end with the top, and they're pretty short-lived. And then we'll show you at the very end here, I kind of narrowed it down, taking all these weather markets, taking the highs, trying to, you know, kind of surgically take them apart and see what drives them, what makes them, what are the characteristics. And I actually even went so far as to say, okay, what days of the week are important? What happens in what days? And of course, looking for the tops because you want to know, you don't want to get caught too long in a weather market and it corrects, takes out half of your run here, half the acceleration phase, and especially if you're trading options, which give you so much leverage. If the market starts to correct, those options deflate pretty fast. But Thursdays, when you look at how many tops are put in and what days of the week they fall on, it's not what you might think a Monday or a Friday. It's Thursdays for whatever reason. And we'll show you that as well. So let's look at some of these. First one we're looking at is way back 1973 when the weather markets first started to kick in. we're looking at the price action. So obviously this right here is the weather market. That's the run, the first part of it. And 73 was kind of peculiar because you had a pretty big correction in time and price, then you had another run. But we'll focus on this one. But getting back to the beginning, markets coming into the springtime in a trading range. Pretty quiet action, pretty well defined trading range. But you have these highs here, and you have this. You even have a gap right here. The market, check this out, the market the next several days hovered right at the top of that gap, started to run, then it came back in and closed the gap. And then you kind of just ran out of gas. You have another little gap here, the market filled it. So this market is stuck. It's in this trading range, pretty comfortable until you get into late April, and then the market has the first gap that's actually preceding this weather market. And then again, the market just hovers here. You test it, got a couple little gaps to the upside, you come back down, you test it. The market makes a run and it fails at this first run here. Then you come back down, and what do? You test that gap one more time, but you can't fill it. The market can't get back into this trading range, which basically was this minor double top here. You gapped above, you gapped out of the trading range right at that top. Now that has become your support level. And it held it for several days, and it held it again when you were coming back down with some pretty intense velocity. The market was giving up here. It had a little run. Obviously, this was a weather scare. Market comes back down to the gap and stops. And then you really start to run. Now you're in a full-fledged weather market. So you have the acceleration starting with this big day up here, and then it just gaps. Now this is when we didn't have expanded limits until you were limit up like 3 days in a row. So, and in fact, I think at 73, obviously you had to have it more than 3 days in a row. But now you come up here, the run from the time it accelerated to the time you put in your high was just 12 days, 12 market days, trading days. Depending on where you want to count this, I went all the way back here to early March, mid-March. That was actually 57 days for the whole move. But it shows you that it happens fast. So you have to be on it. You have to be in front of it. And even if like here, trying to get in on a limit up move, you really couldn't. And people couldn't get out either if they were short. So just to give you some the first chart here, just to give you a look at how these weather markets perform and what kind of action, price action that you have. And back over here, getting into July, I mean, we topped in the 1st of June. You've barely even begun your growing season. Now you had this big correction, and then you have another run here that lasted 8 days. But you have a big outside day higher that starts an acceleration, then you gap. That tells you got something going on. 8 days is all you had. So looking at the next year, that was 1974. Similar story here, where you have a market that's in a trading range, back and forth, very narrow range. You came out of this sell-off into the early spring, got the planting season going on here, everything's going fine. And in fact, quite often when you're heading into dry summers, your planting season is pretty good because you got open weather. Farmers in the field, they get it planted early because it's dry. That is a warning sign, but they're still able to get the crop in. And typically, the earlier you get the crop planted, the better off it's going to be. So the market's not really going to react, even if it's dry, until it actually sees damage, until you're past the point where range would help it. At least they still could help it to a degree, but you're not going to have the full potential that you would have had the moisture been there in the first place. But you're trading in a sideways range. You're narrowing this range as you come into this move. And then you get the initial gap. One more time, look right here. You spent 4 days trying to fill the gap, and you didn't quite get it done. Kind of jabbed down here, and then the market held. It didn't break down, didn't get back into this trading range, and then you come out of that with another gap up here. That was basically your confirmation that we're off to the races. And the market does have a pretty good surge here. I don't start that as acceleration because you had this break here, a pretty significant pullback and then the market really starts to run. So from this initial gap to the rally, and you were done as of the 1st of August, that was 26 days, I believe that says. And then right here, once the acceleration starts, that's 15 days. So the market, having given plenty of opportunity, and this is basically what we're trying to identify is where are we at? You know, how are we actually in a weather market? Where do we want to be here? But the market has these gaps up. It's holding the gaps. It's trading at least sideways, and it gives you. It starts to run, and you know that the market is moving higher. You know that it's got a lot of energy behind it. And that's the key. That's the key that we want. That's actually 28 days from the gap to the top. I apologize, that's kind of hard to read. You can probably see it better on your screen. So that's 1974, 2 years in a row, 73, 74, soybeans had this major move. And of course, 74, you're going to have a more enhanced rally because you're coming out of a drought year. You're coming out of a short supply season, and you're already in tight ending stocks. Now you have another drought year that just amplifies the price action. So 2 years later, we have another one. And here, similar story. You know, look at this trading range. Once again, the market's just pushing sideways. You don't have a trend up or down, but you're in a very well-defined range. When it gaps right at the top of the range. And to me, that's the best signal that you got the start of something big here. Number one, it gaps above resistance. Number two, the market holds it. Here, in this particular year, you really didn't come back and test the gaps. But the previous two, you saw it break above the trading range, and the market tested that gap several times. That's where your buying opportunity is. You just buy it. You put a stop below the gap. It's a very small risk trade in front of what potentially could become a very big trade. That's why gaps are so important, especially now when you don't get them very often. But just now, so now you have here, you have the signal, you get in, market starts to run, and it just grinds its way higher, steadily, steadily, steadily higher. It's a little bit of correction, hardly anything to even look at, but you have a few gaps in here, but they're not just a screaming type of run, but it is definitely a very strong market. And then here, once you start to see the acceleration, you have this gap up, it takes you out of this swing high here, then that's just 6 days, boom, from the acceleration to the top. The whole run, depending, you know, starting here, was only 34 days. That's how I'm counting that one. From the gap up to where the high was put in was 26 days. Now here we have another one here that you had this big correction, and then you have another acceleration. You have the gap. Market actually came back and filled this gap this time, but then you followed it through with an outside day higher and another gap. So you have this second acceleration, which really screams. Now you've got confirmation that you've got some serious damage to the crop, and you're looking at another short year. I'd like to also, in a situation like this, where you have a major high, pretty significant correction, and notice where the correction went. It went right to one of these gaps again. And then you have another high. If you're trading options, if you buy out of the money calls and you're looking to, part of the reason you're trying to, you know, identify how many days to look for is you want to know when to get out of these options, because when you have a correction like this, the options deflate very quickly. And the run into new highs, quite often when this much time has passed, you will not see new highs on that same strike price because the volatility has dropped so much from from this initial run. So the fear and the unknowns are much more prevalent here than they are here. You know a lot more here than you do here. So you can see you have again, you have the trading range, you have the initial gap out of the range. You didn't quite test it, but the market runs, and then you get your acceleration that starts with the gap. So let's look at another one. The next year was 1980. Once again, we have this trading range. It's quiet. The market is very, very contained in the swing measurements. It's a well-defined range. and then you gap out of it. One more time, you gap right out of the top of the range. It's not like the market comes back down in here and then gap when you're still in the range. You have the market gapping out of the resistance. And you didn't test it this year either. It just ground its way higher, and then you start to get the gaps. Then you start to get the panic that the crop is definitely being hurt. You're losing yields, you're losing production, and again, there you start in your weather market. Once the acceleration began, that once lasted 11 days. From the gap, it lasted 18 days. The whole move. This one was easier to define as far as a low, excuse me, but it was right here, 31 days. It's not a lot. It's 7 weeks, or yeah, not 6.5 weeks, 6 weeks basically of trading days. So once they really get rolling, and this encompasses a couple weeks just of trying to get out of the trading range, basically. But once they really get rolling, it's not very long. It's about 3 weeks, 3 or 4 weeks, and your weather market's over. So by the time you're looking at it, by the time you hear it on the news, it's over, really. And when you hear it on the news, you know it's over. That's kind of the slam dunk there. Let's look at 1983. So here you have, since from 1973 to 1983, you've got, what, 6 weather markets in 10 years. They were all bunched in. So here you did not have a trading range in 1983. The market was definitely in at least a shorter term downtrend. You gapped out of it. You had this low, and then boom, you've got a gap. But you still got a ways to go before you're out of this swing high type of action here. So the market rallies up there fairly quickly without too much of a pullback, and then you gap out of it. Again, the market rallies right up to it and holds that day, and then you gap right out of it. But look what it did. For 7, 8, 9, 10 trading sessions, you kept testing the gap. The market gave you oodles of opportunity to get in this trade. You were testing these breakouts, you were testing the gap time and time again, and with quite a bit of volatility even, and yet the market held. So you could buy this against the support. So the top of the gap really is your support. You buy it, you put a stop below the bottom of the gap, and that becomes your low risk trade. Now here you start to see the acceleration, and it really starts to run, and then you start to get your gaps up in here. And depending on which one you want to take, the first high, again, if you're trading options, you want to be out on this high. So you want to know how many days, identifying when the acceleration begins. You're looking at 12 days to when this one topped. You had a pretty sharp correction, only 2 or 3 days, and the market, bam, came back up. But I will tell you, the options values, the same strike price, the value was less on this day in late August than it was on this day in mid-August. There's only 1, 2, 3, 4, 5, 6, 7 trading days that separated those two tops. And even though the prices are higher here, the value of that option will be less because you have less volatility factor, which was erased by this correction here. So again, that's why it's important that, especially when you're trading the options, which again give you so much leverage, that you get out on this acceleration. Now you'll still obviously do well if you're on here, you just won't be as much. We saw that in 88 as well, but just counting the days here, and again, this was easier to define, the low to the high, 33 days, and then 40 days to that high. But you're really looking at when was the gap? When did this whole thing really become a weather market? And that almost always starts with the gap. And then when did it accelerate? Because once you get into this acceleration and the price action screaming, you're close. You're close to the high. If anybody remembers the wheat market rally of 2007 into 2008, it was a slow grind, just beating up the bears every day for like a year. And then finally you got into that acceleration phase in early 2008 when you saw the markets really get panicky and big trading ranges, got some limit up days. that's when you knew you were toward the end of the run. And it was just a matter of days. So again, getting back to this weather market, you have the acceleration and it's counting the days. Here it was 12 days to the first one and 19 days to the second one. So 1988, that was the big kahuna move as well, the big weather market. It started out here, way back in here was your trading range, and the market started to kind of show some energy very early in the growing season. First part of April, you had a gap up. Look what it did. It came back and it tested it several times. For 3 weeks, the market hung here and was stuck in a range, and it tested that gap, tested the gap, tested the gap. Finally, it breaks out to the top side here above this little rally, this little swing high. Market comes back down, tests that little high. Not a whole lot of energy here, but the market clearly is showing some signs of worry about the crop. And then you start to get it rolling. Around mid-May, you get that gap. And then what does the market do? Boom. It tests it and tests it and tests it and tests it. For 2 weeks, it tested it. Got into the gap several times, couldn't fill it, couldn't break down, couldn't sell off. And then once it gapped again, then you're off to the races. Then it was very short-lived. And this was a weather market of an explosion and then a consolidation, explosion, consolidation. But you had, once the market committed, which basically was right in here, this first gap was really the commitment, especially when it tried so hard to fill it and couldn't do it. And then it was just off to the races here. I also know that looking at the out of the money options, they were higher value here than they were here because you lost a lot of time. You didn't correct that hard, but you lost a lot of time. Another consolidation here, and another week goes by where you get a better look at the crop, you get a better look at what's going on, and yes, you had another acceleration, but from an options perspective, this was your better selling point than it was here. Surprisingly, but it was. So you count the days. Here was, I chose this low because it was the last low before things really started to get exciting. So you're looking at 41 days. Here, from the time the gap really happened and the market clearly was looking at a problem in production, you had the 28 days, I believe. And then you had the acceleration. So you're looking at 18 days there. Let me double check my other charts here. I apologize. These are pretty small numbers here, but yeah, it's 18 days and then 41 days down here. And then the acceleration. The last one was 7 days, and then it was 18 from this acceleration. So let's look at the next one, 2012. That's the one most of us would remember. Again, the market was not expecting much. For most people, it was a surprise, but even during May, so going back to the Browning newsletter, it was the May newsletter that they started talking about hot and dry conditions coming into the central part of the United States. I saw that on the 1st of May is when I got that newsletter. And look what the market's doing. It's totally, they're obviously not reading Browning or something. They were getting rain or whatever was happening. But the market had this double top going here, failed at there, comes back down during the month of May. Good planning conditions, everybody's fine. There's not a big problem. Market rallies, comes back into this resistance level, and then you get this little gap going on right here. Okay, so then the market holds that gap and then stalls right at this resistance level, this old double top, which basically now has become kind of a minor triple top. Can't break it, and then boom, it gaps above it. Look what it does. One more time. It gives you all the time in the world to get on this move. Comes back, tries to fill the gap, can't do it. Tries to get back below this triple top, can't do it. We're hovering. Clearly now this pretty significant resistance has become support. Gives you tons of time to get a position on, especially if you're reading Browning and they're already talking about hot and dry conditions. By now, you've got your second newsletter that's talking about hot and dry conditions. They're still talking about hot and dry during June, and the market's starting to see this. It's starting to happen, and the market's starting to react. And then you get your move. You get the gaps up, you get the acceleration, which lasts 16 days. And from the gap, that's 24 days. From the low, which is pretty well easy to find here, to the top is 35 days. So it's very short. Even if you take all this time that you were stuck in not even being able to get above this double top, the market hasn't been able, you've chewed up half your time of the weather market. It was only 24 days from the time it gapped higher and you're still under here. From the time the acceleration begins, it's just a mere 16 days. And I will tell you from experience trading these markets, 16 days can feel like 16 years because you're in this market, even if you're on the right side, even if you're making tons of money, you're still wondering, all right, where am I at? What am I doing? Your clients are calling. They want to know where are we at? Where are we going to get out? Should I buy more? There's tons of questions. And so that's why having the historical perspective and having some numbers in front of you and kind of zeroing in on, all right, what's the average? What does it normally do? What do I look for here? So what I did is I put it all on paper. I just put it down every year. I said, okay, what was the day of the gap? What day did it happen? What day of the week did it happen? How long did it last? Where was the top? How long was the gap? You can see this graphic format. I just wrote it all down, and so it gave me some perspective on what does a normal weather market look like. So in 2012, I'm trading that, and I'm looking at the history here, going back on what happened before. What should I be looking at? So what I did then, I broke it down even further. What are my days? What should I be zeroing in on? What should I panic when it's only 7 days from the gap? Would that be a top? Probably not. Even 18 days, because that's a long time. It's a long time to be in a market that's moving fast and furious, and you're seeing profits mount up. You don't want them to get away. You're talking to clients, they're seeing profits mount up. You don't want their profits to get away. So you're trying to develop a window of when would this market top out? When would be the most likely time for it to top out? Because it's always going to happen before you think it should. That the weather, it's still going to be hot and dry long after the high has already been put in the market. And you're going to be hearing about the drought on the news, or NPR is going to do a story on the drought. If you are still in the market when you hear the news talking about it, you really need to get out because it's done. Even if market's still putting in another high, you know you're close to being done. So this is what I did. I went from the gaps, I identified the gaps as we saw in all the charts back here, and then identified the top. Of course, tops are pretty easy to find unless you got a couple of them congested right in there, which some of the years did. But basically, this was the window. Now these are several days, but from the gap to the top, you're looking, it's going to be in the 20s. So let's say you're at day 14. You're like, okay, it's just 2 weeks now, 3 weeks going on of the weather market. You're losing sleep. You can't figure, you're trying to think straight. You go back to this, okay, the odds are pretty strong. You're going to be at least in the 20s before you get to your top. So it at least gives you some perspective here. And then when you really want to zero in on it, you know that these tops are going to happen from an acceleration base. I shouldn't say base because that kind of confuses the acceleration. But the tops are going to come in a weather market. They're going to happen after an acceleration phase. So how long do the accelerations last? Well, you're pretty much, you see 12 to 15, 16 is kind of right in the median here. Look for that number and look for price action. When you get into day 12, I'd be waiting with finger on the trigger, ready to take some profits and just at least peeling off. By day 12, I'd be peeling off some of the positions, saving some in case you get a big kahuna and you get way up to here, but you at least want to be peeling off something by day 12. So total days to the top, Again, that's even more, if you can identify a pretty, uh, the low, that's sometimes kind of hard to really zero in on unless it's very well defined. But look at this, 31 to 36. That's a small number, and they all seem to be congested right in there for total days of the weather market move. And then days of the week for the tops. So I'm like, okay, would you think that a top would come in on a Monday after you've had 2 days where you can't trade? It's still hot and dry in Iowa. Is the market going to explode, and then is it going to blow itself off on a Monday? Pretty unlikely. For whatever reason, Thursday was the one that really popped out there. Certainly not, usually not Friday or Wednesday. Tuesday, sometimes that would come after the crop condition report on Monday afternoon. That would certainly be a reason the market would have another reaction higher. Thursdays seem to be the day. Fridays, it could be just you just want to take profit before the weekend. Maybe there's a forecast of rain. Maybe there wasn't the forecast of rain and they got some, or whatever reason. But it seems to be Thursdays. So if you see an acceleration that's lasted 12 days and it's a Thursday, yeah, I'd probably take off 2/3 my position instead of just a fourth or a third. I'd get a little more aggressive if I see Thursday falling on day 34, acceleration in the 12th day. I'd be leaning pretty hard on getting out of the market, willing to give up whatever else might come to the upside, knowing that uh, the odds are on my side, that we're running out of time. So that's kind of it, short and sweet, but you can talk more on this. If you have any questions, I'd be happy to answer them, but this is kind of it in a nutshell. You're looking at weather markets. I guess the whole point of that I thought about doing this as a presentation is, number one, climate is changing. Why it's changing is to me almost beside the point. I'm not here to discuss politics or who's responsible or what's responsible. I just know that it is. If you're a farmer, you've been in that camp for a long time. Now, okay, weather patterns are changing. My weather service is telling me for the next 10 years we're going to see some significant changes in production because of the changes in weather patterns. Well, as a commodity broker and a trader and a grains analyst in particular, and a cattle analyst, that matters to me. That just presents an enormous amount of opportunity that I want to take advantage of, and I want to be ready for it when it happens. Whether I'm trading futures, whether I'm trading options, whatever I'm doing, I can figure out how to get the position on. I just need to know when to do it and when to take it off. That's the key. And this just helps me do that. It helps me put it in a framework where I can go back and I can look at it when things get really hairy, and when you're in the third and fourth, fifth week of a weather market, and you're trying to keep your cool. This helps me do that. So any questions from anyone?